Hello, in this video, we'll be going through changes in accounting principle. There are three different types of accounting changes that can occur, and the accounting of how to record those changes differs depending on the type of change that it is. There's the change when we have a change in accounting principle, a change in accounting estimate, or a change in reporting entity. There's also correction of an error. But in this video, we're going to be focusing on how to account for a change in accounting principle. A change in accounting principle is when a corporation changes from one generally accepted accounting principle to another, and that can occur several ways. Number one is that if there's a new accounting standard that's issued that a company must adopt, then they have a change in accounting principle. If they decide to change their inventory methods from LIFO to FIFO or whatnot, that would be a change in accounting principle. Or if they change the way they account for their investments from the cost method to equity method or vice versa. Now, these are just examples, but hopefully you can understand what we mean by accounting principles versus a change in accounting estimate. If you're not familiar with these changes, of these different type of changes, please go see the video for introduction to accounting changes for more detail. So again, we're going to be focusing on the change in accounting principle and how to record those changes. There are three different approaches when we're talking about accounting changes that can take place. And there's the retrospective approach, modified retrospective, and just the prospective. It's really important that you understand the difference between these three and which approach is applied to which type of accounting change that may occur. When we have a change in accounting principle, we're going to use the retrospective approach. And that means that the financial statements that are issued, the previous years that are shown, are completely revised to appear as if this newly adopted accounting method has been in place all along and it's never been changed. So the numbers just kind of flow and you can compare the numbers year over year. But we do have to change our accounts, right, in order to reflect that kind of change that we show the new balances for the prior years. And the way we do that is we record the change as an adjustment to the beginning balance of retained earnings. Okay, and we're going to go through these other types of changes. We'll go through this a little bit later in the video, and this will be its own dedicated video. So most voluntary changes in accounting principles are reported retrospectively. And the FASB will communicate that they want their accounting principle reported retrospectively, okay? But even if you change it from a FIFO to LIFO or, right, the equity method to the cost method for investment, the companies are gonna account for their changes retrospectively. So what are the three steps in doing that, doing a retrospective change in accounting principle? Number one is you have to revise the comparative financial statements. If you recall, financial statements there's typically 2 to 3 years, right? So if there's X1, X2, X3, and there's all these accounts, you have to change all 3 years on the financial statements as if you have been using the new accounting principle all along. Number two, so there's a difference between actually reflecting in the financial statements, right, on the 10K versus actually adjusting those accounts in our general ledger. And then the third one is have to disclose the changes in the notes to the financial statements, and there are specific things that must be disclosed in those notes, and we'll go through that later. Okay, let's go through an example, okay? Air Parts Corporation used the average cost inventory costing method for both financial accounting and tax purposes. Okay, first, before I even get into this, hopefully you will recall from your income tax accounting chapter that if if the items are treated the same for financial accounting and tax purposes, then there's no tax adjustment needed. However, if income or expense is taken at different points in time between financial accounting and tax, then either a deferred tax asset or deferred tax liability needs to be recorded. Okay, but in this situation, they were using the average cost inventory method for financial accounting and tax purposes, but at the beginning of 2027, the company decided to change to the FIFO method for financial accounting. Okay, so the average cost and FIFO are different inventory methods that you can use. And we're provided with different income components for 2027 and prior years. So they gave us the cost of goods sold using the average cost method, which is their old method, versus what would be the cost of goods sold under the new method using FIFO. And they're giving us this information for 2027 and all the prior years, 2026, 2025, and pre-2025. And they give us the revenue and operating expenses for each of those years as well. So additionally, it tells us that Air Parts has paid dividends of $40 million each year beginning in 2020. Its income tax rate is 25%. Retained earnings on January 1, 2025 was $700 and inventory was $500 million. Let's start. Actually, so let's start with step one. Step one is revise the comparative financial statements. Now, depending on the type of method that's involved, there will be different accounts involved in this, whether different accounts in the income statement versus different accounts on the balance sheet that will need to be revised. Okay, so first we're going to go through the income statement, and you have to change the actual income statements on the face of the financial statements. So here, this top one is using the old cost of goods sold, right? And so we're giving the revenues, and then we're giving the old cost of goods sold to get to these this would be the net income under the old method. Now in 2027 is when we've adopted this new method, this new inventory costing method. So in last year's financial statements, we reported 2025 and 2026 using a $201 and $210 net income. When we issue the 2027 financial statements, because this new accounting principle, right, was adopted, and we always assume it's adopted as of the beginning of the year. So when we report, so we're going to report the 2027 using the new method, right? That's not going to be difficult because we're just now using the new method. However, when we report the prior years that we are required to show on the financial statements, we're actually going to show the income statement using this new cost of goods sold under the FIFO method, and therefore we'll show this new net income numbers on the financial statements as well. This slide, I have removed the 2027 column just because it doesn't really affect our entries at all that we need to record, because when we record our 2027 activity, it will already be under the new method. So for purposes of recalculating some balance sheet accounts and recording the entry that's required, we need the information for the years prior to 2027, which includes 2026, 2025, and everything before that. And we're giving this information, right? And that's what I've listed in this slide. So here's our net income for prior years, 25 and 26, under the old method. That's this blue table. And under the green method, the only thing that's changed is the cost of goods sold. We still have the same revenue, same operating expenses. Income tax expense will change because our income before tax has changed because our cost of goods sold has changed. Okay, so now this bottom row right here is just the difference in net income between the old method versus the new method. So pre-2025, we had a total increase of $225. 25 and 26 is plus 30 and plus $33. So that's just the difference in the income between the old method and the new method. We're still in step one, right, of revise the comparative financial statements. We talked about We just saw how we're going to revise our income statement, and now we're going to focus on our balance sheet accounts and what change, which accounts are affected and what their balance is going to be on the comparative financial statements. The first account we're going to focus on is retained earnings. And why does retained earnings change? If our net income has changed and net income flows into retained earnings, then our retained earnings will have changed. And so this top table right here just shows the net income under the old method versus the net income under the new method. And again, these are just the changes between in net income. And so if those changes in net income, there are going to be changes in retained earnings as well that we're going to need to record. So let's look at now what balances are we going to reflect in our comparative financial statements specifically for retained earnings. We were told in the problem that the beginning retained earnings amount was $700. So in our old financial statements and our 2026 financial statements, when we reflected the January 1, 2025 retained earnings, we showed $700. But now we have a new retained earnings balance, okay? And the new retained earnings balance is going to have this, oops, that's the wrong, it circled around the wrong thing. It's going to have this new adjustment, right? Because we need to, our net income increased by $225, which means our retained earnings increased by $225. So now when we show our comparative financial statements in 2027, we have to show our 2025, 2026, and 2027 balance sheet items. And we're going to have one of them is going to be retained earnings. And so when we reflect our beginning balance for retained earnings, we're actually going to show $925 versus what it used to be $700. Okay, so but then when we have to, so now we have to record an increase to retained earnings for $225. Let's go to the next year. So retained earnings is our beginning retained earnings plus net income minus dividends equals our ending retained earnings. So in our old comparative financial statements, right, our beginning retained earnings was $700. Our old net income was $201. Our dividends were $40. We were told that they paid $40 of dividends every year since 2020. So our ending retained earnings on December 31, 2025 in the past was $861. But now we have to use our new net income, right? Because we have a reduced cost of goods sold, so higher net income. And now our new 2025, ending 2025 retained earnings balance that we will reflect in the financial statements will be $1,116. The change to retained earnings that needs to be recorded in our GL is another increase of $30 for the net income increase. And then we're going to do the same thing for the following year, right? We're going to take our 12/31/25 ending retained earnings. We're going to have our new net income less dividends, and this is going to be the balance on 12/31/26 retained earnings in our comparative financial statements. But when we need to record the change in our books, our net income increased by $33 for that year, and so we're going to increase retained earnings by $33. So in total, we're going to have a total increase to retained earnings for $288. That's what we have to record as a journal entry. And what if we weren't given this information, this beginning retained earnings, right? What if the problem just asks you, what is the adjustment to retained earnings without giving you actual balances? You're just going to take the increase to your net income that took place, and you know that's going to be an increase to retained earnings. Okay, so it really depends the information that the problem gives you and what it's asking for. So right now, let's just start our journal entry. We know we have a credit to retained earnings for $288 because an increase in retained earnings is a credit. Let's go now. Because we're changing our inventory costing method, another balance sheet item that's going to be changed is the inventory balance. This particular problem does not provide us enough information to calculate the new inventory balances to report on the comparative financial statements. Why? If you recall, this is how you calculate your new ending inventory. You're going to take your beginning inventory plus any current year purchases will give you your cost of goods available for sale minus your cost of goods sold equals ending inventory. And so we were told that our beginning inventory on 1/1/25 was $500, right? And we were told what the new cost of goods sold was. I can't remember right now. And however, we were not told what the purchases were for each year. And therefore, we can't actually calculate the new balances that are going to be shown on the financial statements. But we do have enough information to know what adjustment we need to record in our inventory counts in our GL. So if you recall, when a company sells a product, right, they debit, let's say either cash or accounts receivable, and they'll credit sales, right, for however much they sold it for. But in addition, they have to take that merchandise off of their books because they sold it. So they're going to credit inventory because they no longer have it. And that's when they recognize the expense, the cost for that inventory using cost of goods sold. So when cost of goods sold increases, our inventory decreases, as you can see by this journal entry, which means the flip side is also true. When cost of goods sold decreases, it means our inventory is going to have the inverse effect of increasing. So let's go through what's actually happened in this problem. We have our old cost of goods sold given to us and our new one is less than our old. So we have a decrease in our cost of goods sold for the cumulative years before 2025, 2025, and 2026. So now, because we know the decrease in the cost of goods sold is $384 when you add up all those years, that means the inventory balance has to increase by the 384, right? Because it has the inverse effect. So now we have to record a journal entry, a debit of inventory for the $384. So this is just the same information up here as the previous slide. And let's continue building on our journal entry, right? We're on step 2 now, adjusting our accounts for the change. We know we have a credit to retained earnings for $288, and we're going to have a debit to inventory for $384, okay? And that's just going to be the change in the cost of goods sold, the inverse of that. But this entry obviously does not balance. Our debits do not equal our credits. And this is kind of a little bit tricky. So let's just walk through this. We're going to have this should be indented. This deferred tax liability account should be indented because we have a credit for $96, okay? And we're going to take our change in our cost of goods sold, multiply by the tax rate that we were given in the problem. Let's walk through that logic, okay? When we were using the average cost method, we were told that they use the same method for financial accounting and tax. When a accounting method changes for financial accounting purposes, it does not necessarily automatically change for tax. It really depends on the tax rules. And this time, typically tax and financial accounting will end up being different. So now think about what expenses have been taken on the tax return. Okay, because now you have to pretend that for financial accounting has been using FIFO from the beginning of day, and for tax purposes we've been using average cost. So for tax we've been taking these expenses, and for financial accounting we take less expenses, right? Less cost of goods sold. So we're getting a higher deduction in these years, right, for tax purposes because they took a higher expense, which means eventually, right, sometime in the future, that expense, that cost of goods sold will be going through the income statement for financial accounting purposes, but we've already taken some of those costs for tax, so we're going to have to add that back into our income for tax purposes, which means our taxable income will be higher, which means that our liability in the future, our tax liability in the future will be higher, and therefore we have to record a deferred tax liability for the tax effect of the difference in the cost of goods sold amounts. So that's kind of a very lengthy explanation, but this is the only way to make the journal entry balance. Step 3 is you have to report your change in accounting principle in your disclosure notes, and you have to justify why a new method is being used. So you have to justify it. You have to point out the comparative information that has been revised, and if there's any earnings per share amounts that have been affected by the change, you have to report those changes for the current period and all prior periods that were presented on the face of the financial statements. This is a disclosure of a change in inventory for Abercrombie and Fitch. I'm not going to read the whole thing, but it's just, here's a note. It's change in accounting principle. The company elected to change its method for inventory. Okay, and it tells you we went from the lower of cost of market to weighted average. And then it tells you that all periods have been retroactively adjusted, right? That's the retrospective approach. And the company believes that this weighted average cost method is preferable as it better aligns with the company's focus on realized selling margin and improves the comparability of the company's financial results with those of the competitors. This is the reason why. This is the justifying why they had to make this change, and it'll improve the matching the cost of goods sold with the sales. And then it tells you the cumulative adjustment. There was an increase in inventory for 73.6 and an increase in retained earnings for 47.3 million. The second type of approach that could be used when you have a change in accounting principle is the modified retrospective approach. Okay, so sometimes the FASB allows this modified retrospective approach. And the difference between the modified retrospective and just regular retrospective is that the new standard is only applied to the adoption period, right? Which if we were looking at our previous example, it would only apply to 2027. And you don't have to change the comparative, the prior years, okay? You don't have to adjust any of those numbers. We would instead sum up all those entries, right, and just show a difference in the beginning retained earnings number starting 1/1/27 versus the full retrospective showed a new beginning retained earnings number on the comparative financial statements as of 1/1/25. Okay, so sometimes the FASB allows this modified retrospective approach, and sometimes it's just not practical to gather all that information from the corporation's perspective and actually break it out by year. So maybe they know the full adjustment, but they don't know which year it exactly pertains to. So sometimes companies will use the modified retrospective approach for that reason as well. Let's take a quick concept check. Big merchandisers changed from the FIFO method of costing inventories to the weighted average method during 2027. When reported in the 2027 comparative financial statements, the 2026 inventory amount will be what? So first, it tells us that they changed accounting principles, which typically means the full retrospective approach. And when they have to report the prior year inventory, will be increased, decreased, unaffected, or it could go either way depending on how your cost of goods sold change, right? Which depends on how the prices change between the two methods. We for sure know it's not unaffected because for sure you have to change the inventory amount. And the answer is C, because it could go either way. We're not told enough information in this situation to know if it's actually increased or decreased.